Good day, everyone. Thank you for joining us once again here at Seafried and Brew for our economic briefing. We've had an exciting week in terms of releases, not only just economic releases, but we had the Fed come out and have their meeting and then their press release by Chairman Powell. And we're going to review some of that information today. We had GDP come out. We're going to look at that, and then we also had the PCE inflation number come out for June. So we're going to dive right in, review some of these items. First on our list here is looking at the Fed meeting. An overall summary wasn't too exciting, some might say. Nothing out of the ordinary and nothing that we didn't expect. Overall, two primary summaries that we can glean from that release. Number one, it says with progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen, and we've seen that happen in the numbers that have been coming out. Secondly, while that's the case, the overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to U.S. households and businesses. And that's the frame of mind that they're in right now, is to continue this accommodative stance in pushing forward to help both businesses and the households. And the overall outcome, which we anticipated, were to no change in terms of that Fed funds rate, and then also we continue to see that asset purchases at that $120 billion per month will continue. So nothing, like I said, nothing out of the ordinary. Now when we jump into that press release, a couple of interesting comments regarding the raising of the interest rates, and this is in response to some of the questions that Chairman Powell had received. The first question that we're going to show the response to, a snippet of the response to, was in regards to the 2% inflation expectation in terms of their policy, that they want inflation to run moderately above 2%. And part of that response was connected to the timing of the raising of interest rates. So when we look at Chairman Powell's response, it says we're clearly a ways away from considering raising interest rates. It's not something that is on our radar screen right now. Again, applying that we're pretty far off in terms of thinking about that change in interest rates. And then that was followed up a little later with a question regarding asset purchases and whether or not the Fed would perhaps implement the process of continuing to buy assets while increasing interest rates. And here's what Chairman Powell had to say. It says, ideally, you wouldn't be still buying assets and raising interest rates because, of course, they're adding accommodation by buying and removing accommodation by raising rates. So that wouldn't be ideal, I'll say that. So overall, the thought process there is that they're going to wait until they completely end that buying of those assets. Now, that's not to say that they're going to wait until their balance sheet goes back down to pre-pandemic levels. That just means they're going to stop buying that $120 billion in additional securities a month before they begin that interest rate process. At least that's what would be the ideal. So in that light, we can step back and say, moving forward, 12 months, 18, 24, I think we're pretty certain that interest rates for the Fed funds rate will remain unchanged at this point. Of course, that's going to have an implication on the overall level of cost of funds for institutions. We can expect deposit rates to remain low during that time and short-term funding to remain low. So overall, not, like I said, nothing too surprising in terms of the Fed statement. These two items kind of really securing down the thought process of just a continued longer term view of short rates on the Fed side. In terms of GDP, the one thing we like to look at on a monthly basis is that coincident index put out by the Philly Fed. Overall for June 21, they projected the 3-month change at 1.3%, collectively by the state-to-state GDP number. So that came in down slightly from where we were in May at 137. So overall, we still make progress. We anticipate this number to stay right around there as we move forward, unless we see continual increases in cases of that Delta variant. And if we begin to see certain states implement restrictions again, we can see these numbers start to fall off. But overall, very positive looking out across the United States. Only have 4 individual states that are showing declines. Over the last 3 months ending June, we had Alaska, Wyoming, Iowa, and Ohio. So those states just slightly negative there. Every other state fairly positive. When we look at the GDP, that came in at 6.5%. As we know, that was under expectations. We here at Seafried and Brew expected that to come in around that 7.5 range. There were projections out there. The Bloomberg consensus was close to 9%. EcoDay was around 7.8. So under expectations. Why was that? Well, we had a lot of different things moving around. One of the big things was that inventory number. Inventories detracted from the overall growth by 113 basis points. That was pretty substantial considering last quarter it was subtracting about 260 basis points. So we anticipated the inventories number to be a little more positive, which would have pushed up the overall growth rate, but that was not the case. So that's something to sit back and ponder, and we would expect if we have 2 quarters of negative inventory numbers, we would expect a third quarter to be positive. So that's something that should be beneficial to the third quarter number. Now, we also had in the residential fixed investment, that actually declined quarter over quarter by 9.8%. So that was a pretty significant addition to growth in the prior quarter, and we're starting to see that pull off, be it because of the increase in prices or the lack of supply that's out there. But we do see that pull off. We did see, however, non-residential increase by 8%, and that was contained primarily with equipment and technology items that pushed that up. Structures were still negative for this quarter in terms of the non-residential. Consumer spending obviously was very strong, adding 778 basis points to the overall growth level, up about 11.8%. I will say that this number was significantly impacted by the increase in the opening up of the restaurants and the travel industry. In fact, 45% of this overall growth rate, about 354 basis points, were contributed from transportation services, recreation services, and food services accommodations. So that made up almost half of the overall contribution to that growth rate. So that's pretty significant. The question is, can we continue this trend moving forward into the fall? And that's something that, in my mind, is going to pull off a little bit in that growth rate when it comes to the fall. But when we look at the government spending, that was a detractor this quarter by 27 basis points. And the net exports while improved quarter over quarter, was still a detractor by 44 basis points. With that being said, we had the personal income statements come out today, and for June, overall personal income up 0.1%, and the PCE inflation number coming in at year over year at 4%. For the full number, core PCE excluding food and energy at 3.5%. So overall, we had inflation up just slightly from where it was in May at 3.4%. In terms of the core PCE, the full PCE, that stayed unchanged. In my mind, that's giving us that indication that we could start seeing these price increases settle down in here, which was, obviously a hot topic during the press conference. And Chairman Powell continues to say that it is going to be transitory. And you got to remember, when we're thinking about that comment, that's not saying that prices will definitively go back down to where they were. It's just saying that price increase will stop. And we saw lumber really peak up and then start coming back down. So that's what he means by when he says transitory, is that it's not going to be continual increases quarter over quarter over quarter over quarter. There's going to be some spikes and then maybe a pull off. Even if they plateau, that's going to reduce down the overall level of that inflation number moving forward, which would then give the Fed that ammunition to say we're going to continue to have this accommodative policy. When we look at the inflation expectations, we did see it pull off and then jump back up more recently. However, we're still not at that 2.5%, where it's kind of like my proxy to say if we get above 2.5% in this inflation expectation numbers for a period of time, be it several quarters or 6 months, 8 months, then we can expect the Fed maybe to start thinking about that increasing that overall Fed funds rate. We're just not there at this point, even though we had some pretty significant trajectory upward to this point. We're still below that 2.5% on this inflation expectation. And we have to take that into consideration. And we know that the rates have been kind of crazy over the last couple of weeks. When we see from the year end up to the end of the first quarter would be this green line here. End of the first quarter, we saw that rapid increase in those long-term rates. Short-term rates remain relatively unchanged. And then we go into the second quarter and we saw those rates tick down a little bit. We've always suggested that, when we saw the rates come up, there wasn't the fundamentals to really help sustain those increases in rates, and we anticipated them to come back down. And that's what happened. When we look just yesterday, we had the 10-year Treasury ending the day at a 1.28 on the 29th of July. This morning, we've had that number come down, back down to a 123. So that's the overall level of where we see it today at a 123 in terms of the 30th of July during this recording. Now, when we look at the spread between the 10-year and 3-month, we can see we're ticking back down. In March, at the end of March, it was 171. Now we're back down to a 122, a little lower this morning. When we get down to that 1% range or below, that's when we start to get a little concerned in terms of where this economy is going. We're starting to see a little bit of a slowdown. But overall, our anticipation or expectation is that rates aren't going to move that much on the long term. In fact, we would say that there might be a little more of a probability that rates are going to move down a little further as we move through the next couple of quarters versus moving up. Now, could they move up? Sure, they could move up, but our probability, our bet, is that they stay where they are or even move down a little bit. So we got to think about that in terms of ALCO and where we see our asset yields and the replacing of those asset yields that are rolling off. And a big thing, and we'll talk about this next week when we review over the performance of the community bank peer group or the benchmark group for the second quarter. We'll talk a little bit about where the cash position is at most institutions and the risk in holding all that cash on your balance sheets and earning such a low interest rate, under 10 basis points, holding it at the Fed. So we'll talk a little bit about that next week when we review over the performance of that community bank benchmark group next week. So that's what we have for you today. We look forward to speaking to you next week as we review over that second quarter performance. Have a great day, everyone.